Alright guys, welcome back to my channel. For the new subscribers, thank you for subscribing. For the viewers, thank you for clicking this video. So in today's video guys, I am going to be breaking down the simple forex strategy that can help you catch 100 pips almost every single time a setup appears with this strategy. Right now, this strategy guys is called the ICC concept, and you know this ICC concept guys is very simple. It basically just means three things. So it means indication, right? Price indicating where price wants to go. Correction, so price retracing back to an area of interest, and then continuation, right? So price continuing the trend. Now guys, I do suggest you take this ebook. Click the link at the bottom of this video and just put in your name and email and get this ebook, right? Because this ebook is going to really help you guys understand how I use the strategy, right? Because guys, at the end of the day guys, this strategy is very simple to learn, right? You only need three things in the strategy guys. You need to understand your area of interest, right? You need to understand, of course, the ICC, how the market moves, and then you need to understand your pivot points, right? So essentially, where are the turning points of the market? Now, when it comes to an area of interest, guys, an area of interest is very simple. It just basically shows you an area where price has shown you a clear demarcation between buyers and sellers. So in this case here, you can see that price is literally breaking and retesting in this line here, showing you guys that this level here is appropriate, right, for an area of interest, as you can see. So notice how price is literally reacting off of this line. So this is basically what an area of interest is in this case here, right? It just shows you clear demarcation between buyers and sellers and give you guys like a retracement zone, essentially, right? So you see how price is reacting off these levels. That's an area of interest. And then the ICC just basically means indication, correction, continuation. So in this case here, you would think, okay, boom, when price gave this indication, this was an indication right here. This was the indication, right? And then price now corrected itself, boom, like that, corrected itself. As you can see, price now continue to buy. So this is the continuation move right there, boom, right? Now that is the second concept, and then the last concept is now the pivot point. So essentially, pivot points are basically the turning point of the market, right? So depending on what the trend is, right, you would understand what the pivot points are. So for example, in my ebook, I literally tell you guys, when it comes to pivot points, you need to understand how to mark your appropriate pivot points, right? Because pivot points is very essential because it helps you to understand what the trend is and how a trend has changed, right? Now you do know that whenever price is buying up, there's always going to be noise. So you know how people draw their line like this, right? Obviously this is not how the market moves because there's always going to be noise in the middle of these places here, right? This noise is what we're going to ignore. The pivot points are basically this point right here. In the case of a downtrend, right, the pivot points are basically the highs of the markets. So these points right here. So if I told you guys, right, to go to your chart, right, like this, and let's say, and I tell you to mark the chart how you would mark it, like this, right, you would essentially mark it like this, boom, boom. This is basically how you would mark it. So follow me, boom, 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 boom. So you see how I'm literally ignoring this lows right here because these are not the actual pivot points, right? So a pivot point has to be quantified by having at least two candles, right, of the opposite trend. So for example, in the case of an uptrend, price needs to have at least two sell candles to quantify that low as a pivot point. In the case of a downtrend, price needs to have at least two buy candles to quantify that as a pivot point, right? Because once we quantify this as a pivot point, now we know, okay, let's say we're waiting for a reversal. Literally, a reversal just basically means price breaking above that previous high. In the case of a downtrend, once price breaks that previous high, it has changed trend and we're expecting a retracement to then now continue the trend up, right? So this is basically how it is. So if you can really understand these three concepts here, then you can really make trading very simple for you, right? Because guys, if we go to our chart here, you're going to see, right, let's say for example, right, price was literally right here. Now if I was to explain this thinking that you guys understand, then this is basically what I would say. I would say this is the previous low that price needs to break for the trend to change from buys to sells. As you can see, price broke and closed below that low, and we expected a retracement. As you can see, the retracement happened, right? And then price gave us an entry with this shooting star entry right there. And as you can see, price now sold down here, right? So that's basically what it is. As you can see, price gave another indication here. It now corrected itself, and guess what? It sold back down, right, to where an area of interest, as you can see, boom. And then from there, you can see that whenever you see price reacting into an area of interest, it always gives you a pattern that tells you what is about to happen next. So in this case here, you would notice that price literally gave like 3 back-to-back, you know, shooting star patterns. So this indicates a reversal is about to happen, and as you can see, a reversal did happen. Boom, right? And notice again, the reversal happened from here, it bought all the way up here and stopped here, right? So at this point here, price created a high, right? So when price actually broke this previous low here and then created this low, this high now was not the high that price needs to break for the trend to change from buys to sells, actually from the trend to change from sells to buys, right? And as you can see, price approached, right, broke past it, retraced, and what did it do? It bought up. But this entry was basically failed, and you know, it now gave this reversal pattern right here, and as you can see, it now sold, broke past this previous low. So now we're anticipating price to basically continue to trend. So right now, this is the low, right, that price broke for the trend to change from buys to sells, and now this would be the high right here, right? This would be the high that price needs to break for the trend to change from sells to buys. So basically this has to happen, break past this. Once it breaks past this, we expect a retracement to then now buy up. That's simple. And let's say price is right here, then this is the low that price needs to break for the trend to change from buys to sells. So wait for price to break it. Once it breaks it like this, we expect a buy up and then a retracement to the downside. But basically, guys, this is how you can use, you know, a very simple concept like the ICC to be able to catch 100 pips every single day. All right, guys. So I hope you guys enjoyed this video, and I hope you guys gained a lot from this. I will see you in a different video. Peace.